Hi, everyone. This is Jason Burak of Wall Street for Main Street. Welcome back to another Wall Street for Main Street podcast interview. Today, instead of doing a normal interview where I interview a guest, Mo Dawood and John Manfred and I are going to do a discussion. It's going to be more of a stock market wrap, talk about the general economy, update you guys on the things we are seeing going on in the real economy in the United States, globally, and in different markets. So, guys, with that being said, let's just jump right in here and start talking about, what are you guys seeing right now in the stock markets and in the general economy?
Well, right now in the stock market, we're seeing a correction ever since Bernanke and the Federal Reserve hinted at pulling back on QE, which probably won't happen if people read between the line and look at what the Federal Reserve have been saying the past few years. They always threaten to withdraw on QE, but they end up doing even more QE. And, since they started talking about that, there has been a correction. You look at the Dow Jones, it topped around 15,600. Now it's hovering around 15,100. So we're seeing a nice pullback there. So we're seeing a good opportunity for investors out there if they're looking for a bargain. The time is now to do it, especially in the commodity sector, which we'll talk about later.
Well, also, I just want to add is it's not just the stock market that's now calling Bernanke's bluff, but also the Treasury market, where their yields are rising pretty significantly. So I think they're on the verge of announcing probably either more QE or they just say they won't taper, because I just don't think I just don't think they'll taper, but two, I don't think the federal government will let them keep talking about tapering if they keep seeing interest rates just balloon.
Yeah, if you look at the yield for the Treasury bonds, just a few months ago, the 10-year was under 2%. Now it's at 2.75%. So you could see how disruptive the Federal Reserve can be once they start talking about stopping the QE, because it has a major effect on the bond market.
Yeah, right now it's 2.75% 10-year bond yield.
Yep.
And those are some interesting points, guys. And I think here for our listeners, even if the Fed does actually try a taper, it will only be small. It would be like maybe removing $10 billion from that $85 billion a month. And the market could, if the Fed actually did do this, the market could start pricing in multiple tapers all at once, yet, overreact drastically, and then the Fed could reverse course again. So ultimately, in the long term, guys, even if the Fed tapers or doesn't taper, the economy in general, almost all the sectors, except for the shale boom and some of the technology sectors, which are actually doing very well, almost all the sectors are very stagnant or they're contracting or declining. We do have a housing, quote-unquote, recovery, but this is because Congress and the Fed are giving so much free money to the housing industry to prop up real estate prices, to get that wealth effect going. And we've talked about the wealth effect here ad nauseum. I really don't want to talk about the wealth effect anymore because I think it's a load of crap. But let's just summarize our opinion then of the real economy then. Okay, guys? So what's your opinion here on the job situation? What about these jobs that are being created?
Well, if anyone look at websites like ShadowStats and other alternative statistics on an economy, you could see that the economy has never really recovered. Maybe in some certain sector we've seen some type of recovery, like real estate, but overall the economy has not improved at all. If you look at the unemployment number given out by the BLS, which is BS because it's manipulated, they leave out a lot of important numbers in those unemployment. One of them being that anybody that stopped looking for a job are not counted as unemployment, according to the Bureau of Labor Statistics.
Yes, discouraged workers, right? That's called, yeah.
Yep. And another thing that they don't count is people like engineers who, find a job at McDonald's, Burger King, making $10 an hour, they consider them employed. So they're not actually considered as unemployment. But for the general economy, it's not very good when an engineer who put all his hard work and money, going to college, getting all this degree, end up working at McDonald's. That doesn't tell me that we're in a recovery. That tells me that the economy is not doing very well.
Yeah, that would be, sorry to interrupt you, John, that would be misallocation of capital at the microeconomic level, since the individuals are misallocating capital, but the government is giving them, and the economy, because the government is managing the economy and the Federal Reserve is sending incorrect signals.
Well, not only that, I was going to say people that have exhausted their unemployment benefits are also now claiming disability, so they're no longer accounted for unemployed. That's actually a new thing coming up. So, and disability rates are very high, and so that is another way they're fudging the numbers and saying, see, unemployment's down, if you believe that.
I'm sorry, go ahead.
And if I could add something else about the actual job creation here, yes, there are real estate jobs being created in home building and stuff like that. That's an artificial housing recovery, though, in our opinion. There's really no first-time home buyers, people in our age demographic, in John's age demographic, Mo's age demographic, my age demographic, we're not buying houses. We are renting. Okay, we don't have the money to go start a family, to go buy a house, et cetera, et cetera. We are renting. We are, barely able to have some savings, et cetera. Prices are going up rapidly that are being lied about. And also, a lot of the jobs that are being created, if you look at them, they're almost all part-time jobs, guys. And that's not a real recovery. Substituting what used to be, a full-time job at a pretty good salary, a manufacturing job or a technology job or something like that, and replacing them with a whole bunch of part-time jobs, that's not a real recovery.
And I agree. And look at Wal-Mart. They came out with earnings today, and they missed earning expectation. And Wal-Mart is one of the good ways to look at how healthy the economy is doing, because they represent a major portion of this economy, and yet they just miss earnings. So that's not a good sign for the economy. That's not a recovery to me.
Yeah, and I believe over 30% of Walmart's total sales are from people on welfare or EBT cards, and a lot of the nominal GDP growth, guys, that the U.S. government has been claiming that the Bureau of Labor Statistics and other people compiled the statistics for nominal GDP growth, because we don't have real GDP growth, especially when you add in the real inflation rates. We could debate what the real inflation rates are, but almost all this nominal GDP growth the government is claiming is coming from transfer payments, which are, welfare programs, other social programs, EBT cards, which are food stamps, fancier ways saying food stamps that people use. EBT cards don't get discouraged, et cetera, et cetera. And the scary part is Keynesians and neo-Keynesians like Krugman think that that's good for the economy. They think that more people on welfare who have EBT cards, who are consuming, is good for the economy. That is not good for the economy. It is not good for the economy to have millions and millions more people every year on welfare spending who don't have savings, who don't produce more than they consume and save the difference, who don't have money to invest in a new business venture or stocks or real estate or anything like that. Okay, because with savings gives you freedom. If you have savings, you have freedom. You have freedom to invest. You can quit your job because you can live off your savings. You have a whole bunch of options. When you don't do that, you are at the mercy of the state. You're at the mercy of working a job you hate, et cetera, et cetera. It is very, very sad what we have going on. We have really bad stagflation in the economy right now.
Yeah, and I agree with you there. And also to point out that when we see all these people with a welfare card consuming and spending, and yet they don't have any jobs, what's the incentive of working if they just can live off the government for the rest of their life and also get free health care eventually? So there's no incentive for these people to work or innovate or become entrepreneurs.
Exactly, and it's all, sorry to interrupt you, Don, it's all an ideological problem, okay? People think that the government has to give them this and this and this. People should want to do things on their own. They should want to, add skills, work hard, save their money, get a higher paying job or start their own business, produce more than they consume, save the difference, learn how to invest. That's how you form capital. That's how you get rich over time. Or maybe you have a startup company like one of these tech startups that gets bought out by Facebook or Google or something like that for big bucks. We need more people like that in the economy. It's the small businesses that create jobs, not the corporations, which is why Obama's stupid tax policies, I believe he's going to try to tax small businesses more and give corporations tax breaks. It's just ridiculous.
Well, that's what he's been doing. So that's pretty much the people that are hurt the most by his payroll tax are definitely small businesses and the compliances. Small businesses, they just don't have the money to comply. The tobacco industry, they're a perfect example. Philip Morris, there's Altria. There's not much competition in tobacco and alcohol industries, and the reason why is it's heavily taxed, it's heavily regulated. It's almost impossible to be entrepreneurial in those industries.
Yeah, and the Obamacare has been the main driver of a lot of these part-time job guys, is because there's a whole, and then you add in all the pension fund guarantees from, if you're an employee and all these other benefits, and the businesses can't pay them because in a lot of these industries there is no real recovery. So it's just it's creating. I believe the term is negative feedback loop. Is because the stupid government monetary policy, stupid government tax policy, adding on Obamacare to business people, it's just hurting the American job creation thing. Now, there are some industries that are still creating jobs, but if they keep piling on taxes and rules and regulations, that's going to stop too.
Yeah. Well, the thing is, if government got out of the way, we could create jobs. Like this fracking boom that has created jobs and has made us energy independent from a natural gas standpoint. Not energy independent, but energy independent from natural gas. We did that without government even knowing it existed.
You mean not needing to import any natural gas, John?
That's what I meant.
Yeah, prior to 2007, I believe the Energy Information Agency, which is predicting we're going to become fully energy independent, they have a horrible long-term track record. The EIA and the IEA, they're predicting now that the U.S. government, they predicted, in 2007, that the U.S. government was going to import tons of natural gas. We found all the shale deposits because the natural gas price went so high, and now they're predicting we're going to be fully energy independent. I'm thinking they're going to be wrong again. But let's talk before we get into the oil market, guys, because we really wanted to cover that because getting some emails from people asking about that. Let's also talk about the general stock market. And on our Facebook fan page, for our listeners, please go check out this really great article by past Wall Street for Main Street guest, top value investor, money manager, and author Vitaly Katznelson. He has a great article on there about PE ratios and the stock market. Okay, so what's your opinion, guys, on the stock market here? Are we overvalued? Are we undervalued? Are we fairly valued? What do you guys think?
Well, it depends on what sector you're trying to invest in. If you are trying to invest in commodities, they're very undervalued. A lot of bargain prices out there. If you're looking at other sectors like retail or the banking or some of these other sectors, I think a lot of them are fairly valued or they're lagging as well. So it kind of depends on which sector you want to invest in. But overall, the stock market, I think, will continue to correct until the Federal Reserve switch gears here and pull back on their talk about pulling back on the QE program, which probably won't happen. I don't think the market will crash. I just think we're going to have a small correction here, and then it'll go back up. Because the last thing the Federal Reserve wants and the U.S. government and Congress is the stock market crashing, because that would not be good for them politically.
And it wouldn't fit in with their wealth effect paradigm, and you have all these white papers from Carmen Reinhart, of Reinhart and Rogoff. There's other mainstream economists writing about the wealth effect extensively, saying it works even though it really doesn't over the long term. And then there's Ray Dalio writing about the wealth effect, who's one of the top hedge fund managers on Wall Street, and he's begging the Fed to do this, controlled financial repression, wealth effect, stagflation type thing to devalue the debt in nominal terms. So it's just very interesting what's going on, Mo. I think from a general stock market perspective, after reading Vitaly's article, and I kind of have my own thoughts on this, looking at stocks like Coca-Cola, they're just very solid businesses, but the market is paying 20 times, I think, current earnings or forward earnings for next year's earnings for that stock, and they have no growth. And the only reason the earnings per share is going up is not because they're growing their revenue. It's because they've cut expenses to the bone, probably firing employees or something like that, and because they're buying back their stock. So this is a situation here where we might have profit margins peaking. Because how many more expenses can we cut? Can we replace every single American worker in the United States with robots or one of these algorithm software programs or something like that? I don't know. We're going to run out of ways, though, because wages are rising for manufactured goods. Wages are rising very, very rapidly in China. I believe they have doubled or tripled in the last 5 or 6 years.
Yeah, wages they're growing everywhere in the emerging markets. So they're not going to be able to outsource much longer unless they want to take on some serious geopolitical risk, and I don't think they'd be willing to.
Yeah, and what I would add, too, about the PE ratios for our listeners here is you should own some general stocks, okay? We are big commodity guys, but you have to own some technology stocks. You have to own some real estate if you have the money to do so, some cash flow real estate, maybe some rental properties, or some real estate investment trusts. And then you should also own some dividend stocks or some small caps or something like that, just for diversification purposes, just to be smart in asset allocation, because gold and silver, as we've seen, guys, for the last 2 or 3 years, 2 years or so, they're not going to go straight up. Okay, maybe the last 12 years prior to this year they did, but that was unusual. So a correction like what we had is pretty normal. It shook out all the weak hands, etc. I think there are still a lot of value in the general stock market. It's just not all the large cap dividend paying stocks unless there's something wrong with the company and the market overreacts. But I think there are a lot of values in the small and mid cap companies in the general stock market, companies that are still, efficiently running their business. They're doing more with less. They're being very productive. They're growing their revenues. They have good margins, and they're buying back their shares or they're increasing their dividends. And they're not doing it the way the large companies are, which is just with, cheap debt. So that would be my analysis of the stock market. I would agree with Vitaly, but Vitaly is predicting a crash too. And what I would say is I don't think the Fed's going to allow a crash. If we have a 15-20% correction, even after the debt ceiling or taper or anything like that, what's going to stop the Fed from reversing course again and just putting more money into the system? And I think that's what the oil price and the gold price guys are starting to show us, right?
Well, I would say oil is a lot of it's the geopolitical tensions. Egypt is not doing well, to put it mildly, and there's also Libyan supply disruption. So a lot of the geopolitical turmoil, which I don't see it getting any better. I think it's going to get worse and worse. So I would say that's the main driver of the oil prices. I definitely see that and not only that, the U.S. inventories are shrinking. We're supposed to be in a wash with oil, and now the inventories are saying something different. So the Shell boom, which all it really did was prevent a super spike, or at least put one on hold.
Yeah, and we addressed, for listeners out there who do not have a copy of our Petro Profit Report, please email us at our main website at wallstreetformainstreet.com. We'll email you a free copy of our Petro Profit Report. We were about a year early in predicting all the things that would happen in the oil market. They're happening now. And to add to some of your points, John, about the oil market, and maybe Mo can chime in here about this if he wants to, yes, the market said, China slowed down, but China demand is still growing. Yes, it is growing at a slower rate, but it is still growing. These people are buying, Chinese people are buying their first ever car. India, they're buying their first ever car, and they want to drive. So they've been saving up their money prudently for many, many years, finally buying their first car and their drive. And I don't see this cutting back. I just saw an article, I think, out of Barron's, and it was saying that they believe China is going to be the world's largest oil importer in the next couple years. So that's just amazing. China, I think only a year or two ago, China became the second largest importer of oil, and now they're on their pace to become the largest.
Yeah. Well, the U.S. has been importing less because of Shell, but they're still going to import a lot. I don't see the U.S. we consume 18 billion barrels a day. I just don't, and one of the...
18 million? Or, yeah, you said...
18 million, yeah. Okay. Sorry, I mispronounced.
Okay.
But I was also going to say in terms of the U.S., one thing the EIA or IEA, the Department of Energy predicted is that U.S. Demand would decrease, and that has not been the case. You can tell by the supply inventories. U.S. demand is going to remain persistent, and with growing China, India, and emerging markets demand, it's going to start ratcheting up year after year, in my opinion, until the subsidies are cut, and that will take some huge political will. And when I mean subsidies, not what like the liberal politicians say, but I mean China, where they subsidize consumption there, and Africa, and they tried to cut one, but the people went nuts and they couldn't cut it. So a lot of places, Saudi Arabia subsidizes their consumption, and they just won't do it because they're trying to win votes.
Yeah, I think it's really funny, guys, that the mainstream media is predicting almost every day, they've been doing this for years, that the oil price is going to crash. And you look at most of the people who are commenting on this, even some of the experts, the talking heads they bring on, don't fully understand the market like we have in our Petro Profit report. They don't understand that 13 out of the top 13 oil producers in the entire world are national oil companies. These are government-run operations, state-owned enterprises. And they're not run, except for maybe the Saudis one, which reinvest profits back into growing oil production, growing oil reserves. Most of them just spend all the money and don't reinvest it into their oil business. It's used to fund all their social welfare programs, fund their regular government, bribe their citizens, prevent civil unrest, etc., etc. And this is why you're seeing the industry spend now. I just saw a statistic on this from Barclays that came out this week, and said about $625 billion with a B per year now in capital expenditures is being spent by the oil industry every year just to keep the production levels at the same level or slightly move them higher. So we are seeing demand grow faster than supply, and that is because shale is a temporary cure. Where these shale wells, after 3 years, the decline rate is greater than 90% for most of them, right? And then on top of that, you're seeing very large decline rates at a lot of these older existing oil wells like Ghawar in Saudi Arabia and the North Sea and Venezuela. Their production is declining at more than 5% per year. So at best, shale oil will help the United States so we don't have to import as much expensive oil, but it's not going to solve the global problems because the production rates can't stay up that much, and we're spending so much more money drilling the oil out. This is higher cost oil.
Yeah, and one thing I actually see coming is Canada's right now shunned, and people label oil sands as dirty oil. I think Canada will be going from worst to first, eventually from being shunned to being able to dictate who they want to sell to. So, and right now I think China's treated them the best, and they'll probably be exporting most of it to China.
Yeah, and we're starting to see some.
Canada. So.
Yeah, and we're starting to see some big money going to Canada, John. Warren Buffett and T. Boone Pickens just disclosed in their 13F filings that they bought very large stakes in Suncor. So this is probably a good sign for the Canadian oil industry. There's some infrastructure problems that you mentioned about there, how they don't have pipelines or refineries, right? So I think if Canada can solve those problems where they install new pipelines, maybe the Chinese fund it, or a master limited partnership company from the United States or something funds it, and then they add a refinery there so they don't have to sell their oil at a discount and pipe it down here, to Cushing, Texas, or to the Gulf of Mexico. Canada is going to control its own destiny then and make a lot more money. I
actually wonder if Buffett, because he's very tight with the railroad industry, and since they do so much with Canadian oil, I wonder if he got an inside tip about there's certain infrastructure progress that's not been made to the public. It's just my personal opinion, but I wonder if
probably, John, because he got sweetheart deals on GE, got sweetheart deal on Goldman Sachs. He almost got one on Lehman. He was waiting for confirmation Lehman was going to get a bailout, and he was going to do it on Lehman too. He was going to get a really high mark, like a deal no one else could get, and then he bought. I don't know how sure he was on the railroad or not. Who knows who told him what? Because normally he wouldn't buy something like railroads. It's not something he would buy.
Yeah.
And also, if you look at the chart for the oil market, it's been in a trading range since 2011, hitting a high of around 110 and the lows at around $80, and it's been going in that trading range. And we talked about this in the Petro Profit Report about the petro business cycle, how when the economy is growing, the price of oil starts to go up because demand starts to pick up. But now we hit 110 again. Now the economy starts to slow down a little bit. We're starting to see the price stall and look like it's about to pull back now again. So we're continuing to see the trading range for oil go between 110 and $80.
Yeah, and eventually I think we're going to see, we talked about this in our Petro Profit Report too, higher and higher trading ranges, because all that cheap oil that's been producing for 80, 100 years, the production and flow rates are just going to decline. The costs are going to go up. They're either going to have to flood the well with enhanced oil recovery. They're going to have to refrac it. That's going to cost a lot more money. Or the well is going to be shut down because they're not going to be able to get the oil out. So then they're going to have to go to shale oil and oil sands and try to drive up production costs. And there's just no technological innovations right now that can prevent shale oil, oil sands, deep water offshore, Arctic oil, enhanced oil recovery. There's a price floor in the oil price for all of these things. Different price floors at different levels, but you guys get what I'm saying, though. Plus, energy return on energy invested for a lot of these types of things, especially oil sands and shale oil, is extremely low. Because in the past, like there was a great article on this earlier in the week, we spent, actually there was an interview from Steve St. Angelo on SGT Report, listeners. We can post that on our fan page if our listeners go check it out. He was saying how originally when we found, oil 100 years ago or 150 years ago, it only took us 1 barrel of oil to find 100 barrels of oil. That's a good investment, right? Spend 1 and find 100, right? Now it takes, now our energy return on energy invested, I think, is way less than 5 for most of the oils that we're investing. So it's dropping lower and lower every year. So it's just it's a law of diminishing returns, which is a sound, it's a principle there. It's a law, an economic law.
Yeah, from we're seeing a lot the production costs for a lot of these oil projects to be around the $95 mark, even the triple digit area as well. So the production cost is not what it used to be 100 years ago when it used to be $20 to $30 per barrel.
Oh yeah, the production costs for mining and oil are just going up a lot. There was a Bernstein study, I think, for the oil producers, and that in the last 8 or 9 years, the oil production costs have gone up about 10% per year. So if you're going up at 10% per year by the Rule 72, that means your costs are doubling every 7.2 years. That is insane. Costs for mining, production costs rising, just in the last, really since 2008, 2009, are even worse than that. So that transitions us. I think we covered oil a little bit, guys. So there's interesting fundamental stuff going on in oil. The developing world is not really recovering right now. China is slowing down, and yet the oil price is stubbornly high. So it's very interesting, but if the oil price goes too much higher, it'll crash the economy. Is that what you guys agree on?
Yeah. And one other thing is just not besides shale. I'm just looking at Total. Their profit margins for $100 oil are really low. They're around 5 to 10%. And so that just goes to show national oil companies have higher cost of, and that's most of the oil, and they have a higher cost of production because they need it for social programs too.
Plus they're not reinvesting their profits, John, into finding more oil.
Yeah, but I mean just current production will allow correction in oil.
Yeah. So anyone. I mean, we could have a crash if the market crashes or a sovereign like Italy or Japan crashes. Oil prices could temporarily crash, but they're not going to stay this low as long as central banks are keeping the economy going by printing money.
So,
that's
Oh, I was going to say one thing is if you want to look at an oil producer to look at margins, Exxon is the world's largest natural gas producer, so don't look at them as a fair valuation. Exxon, they have a lot of exposure to natural gas. So,
okay, guys. Well, let's transition then to value in the markets, like in the resource sector, and then we'll talk about gold and silver, and then wrap up the podcast here. So, over the last couple weeks, guys, we've seen a tremendous crash in a lot of the potash stocks. Let's talk about the potash market for a little bit then. What is your guys' opinion of this? Do you think this is a falling knife, or do you think this is a good value opportunity here for longer-term investors? And by longer-term, I mean someone who can buy and hold or add to a position at different levels lower and be patient for 3 years or something, at least 2 or 3 years, and get a really good return.
I think the potash stock are a bargain right now, especially the one we've been looking at for the past few years. I don't know if you want to give out the name of that stock, but right now it's at a very good bargain. And the project that they have is out in Africa, which has
that's a junior mo. Let's just talk about the companies that are making money.
Okay.
Yeah. So the larger companies like Potash Corporation, POT, Mosaic, MOS, those are some of the lower cost producers. There are some higher cost producers like Intrepid Potash, who are, I believe Potash POT produces potash for around $120 a ton all in. And the potash price it hasn't come down that low, but a higher cost producer like Mosaic, who is producing potash for over $200 a ton, that's going to really hurt their margins. So everyone's getting hurt, but some people a lot worse than others. I said Intrepid Potash or Mosaic for the higher cost. Intrepid Potash is the higher cost. Mosaic is one of the lower.
You said Intrepid. Don't worry.
Okay. So yeah, I think these stocks. Potash last time I checked it earlier in the week, its dividend yield was around 4.85%. They're not going to go bankrupt. Let me just outline the potash market really quick. There's these cartels. There was Canpotex in Canada with like POT and Mosaic and stuff, and then there was the Russian, Belarusian, Ukrainian cartel. So there's two separate cartels, and the Belarusian potash company is breaking away from the cartel, and they're going to try to sell more potash production, probably because their government needs to pay their bills and is spending too much money. And they were going to try to flood the market, but no one trusts. If you're buying potash, if you're a Chinese farmer group, Indian farmer, American farmer, you're not going to fully trust buying all of your supply from a Belarusian potash company. You're just not. People don't trust the Soviet blocs and those guys doing full deals with them normally. That's just the way things are. They tend to have a bad history, no rule of law, those types of things in their country. So if you put a big investment in there, they could screw you over. So I think at best, people for sure are going to want to diversify their supply and lock in a long-term supply contract from a company like POT or Mosaic or something like that. And yes, it's going to be at a lower price, but you know what? At a lower price, it's an economic law, guys. Normally when the price drops, except for stock prices, normally when the price drops in a consumer good, the demand for it goes up, right?
Yeah. Supply and demand, yeah.
Okay, so I think we talked about potash here. Any other commodity sector?
Well, I just wanted to say that you look at the PE ratio for Mosaic and Potash Corporation, they're very attractive. Along with the dividend yield, as you said, for Potash Corporation is 4.5%. The PE ratio, that 12, if you look at Mosaic, the PE ratio is at 9, and they also have a dividend ratio at 2.2%. So these two companies are a pretty good bargain right now, in my opinion, and the stock price is at 50% of what it used to be a couple of years ago before the potash market kind of corrected.
And
I was just saying, I bought potash for my dad the other day, and the reason I bought it is to turn into a dividend stock for my dad. And I was thinking, wow, this is a great opportunity. You get a great company with great growth, like a mid-tier growth opportunity, but you get the large cap dividend with it. So
yeah, and they're a low cost producer, guys. Most importantly, that's very important. If you're going to go into the potash sector right now, guys, we don't know when the exact bottom in the potash sector will be. It could be lower, could take months, could take a year. We don't know. Okay, but if you're getting paid a good dividend yield, you have to. If you're going like bottom fishing, going to look for undervalued assets, a distressed asset play, as this market has turnaround plays. You are looking for lower cost producers, so you need to look at production costs. You need to look at the balance sheet of the company to make sure they don't have too much debt and things like that. So a higher cost producer who has too much debt, they might go bankrupt, or maybe they're forced to get bought out for a really low valuation by POT or something like that. So that the sector might be forced to consolidate like that. What we've seen, though, is all these companies have announced prior to this drop in the last few weeks, they announced humongous production cutbacks because the potash market was already in the process of bottoming. So you've had production cutbacks, cutback on exploration and development. So look for production costs, look for companies that can generate free cash flow in a low-price environment. But eventually, though, guys, from a fundamental standpoint, right, unless the farmer is doing full organic farming, with composting and stuff like that, they're going to have to buy their potash every year or two to redo their soil as fertilizer, right? So they cannot wait more than a year or two to buy potash. And since they saw the price go down, I'm thinking farmers all over the globe are going to want to lock in at least some of their potash product now at these prices because maybe hedge their bets a little bit.
And that's a great point there. So now that we discussed the potash, let's talk about some of the other natural resource play out there. I know we talked about energy a few minutes ago, but what about the energy stocks out there? A lot of the MLPs and oil trusts are pretty attractive right now. I know, John, that's your specialty.
Yeah, definitely. I was looking at this one trust, MVO, and it's sold off with the stock market despite the oil prices. And right now, that is a 11.2% dividend yield, and they have 7.8 PE ratio, and their profit margins are 97%. Now, oil trusts, they're limited, but MVO has a lot of good assets, and it's a way to play the shale boom without actually having to incur the negative cost about it. So it's a very good, the royalties, which are a great way just to get if you want dividend yields, they're doing really well. The oil stocks haven't really participated much with the oil rally, but I think they will eventually, and they definitely will, especially I think the mid-tiers are going to become the sweet spot, especially something like Pacific Rubiales with great management, great capital. You see Warren Buffett, he's getting into Suncor, so...
Yeah, I think, John, to add to your points there, I think we're going to see a large consolidation where some of the mid-tier producers like Rubiales, maybe EOG Resources, start to take out some of the really good junior producers or the juniors with the best actual assets. Maybe they don't have production. So I think we're going to see that soon because the ones that are actually producing the oil, right, their stocks are not being valued right, but they have more cash flow. So that eventually then they're going to start using that cash flow productively either to buy back shares, increase dividends, and or do acquisitions. So I think that's what we're going to see. I see value all across the sector, except some of the MLPs, in my opinion, have gotten ahead of themselves. Their valuations are trading at much higher valuations because they're paying such high dividends compared to regular oil equities, the C corporations. If you compare valuations of MLPs to valuations of oil C corporations, the valuations are really far out of whack. I don't want to go into detail on too many of these, but in terms of like a crazy panic stock where the stock has been drastically oversold, what has caught my eye, and I've talked about this I think a couple other times, is Lin Energy. Now, I don't know when the bottom in Lin Energy will be, so there are different ways to play it from a hedge perspective. You can buy a long straddle, which is a put and a call, and I expect it's a battleground stock because the shorts are saying, their business model is not sustainable, blah, 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 blah. We don't like the accounting they're doing, even though they're doing proper hedge accounting, blah, 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 blah. And so, a battleground stock like this where people are heavily shorting, people are digging in, heavily shorting it, and the longs just buy more and more of it, these stocks are going to be incredibly volatile. Look at the volumes on Lin Energy and Linco. So long straddle position, buying a put and buying call, if you have it at the right strike price and you give yourself enough time to let a trade like that play out, you're going to make a lot of money. The stock is not going to stay flat. Either all the accounting issues and the SEC investigation are going to go away, and they're going to do their acquisition and the stock's going to go through the roof, or the stock's going to drop quite a bit more, and then your put's going to pay off, and then the stock's probably going to, they could get bought by someone else, or the stock's going to go up a lot after that once new management comes in and fixes things. So this is just something you can do. You could do another hedge position with a long position and a married put. The thing about MLPs, guys, is there's a lot of tax issues. with them. You got to fill out a K1 form and other things. So that's why Lynn Energy created Linco, which is a C corporation. It buys and holds the MLP shares in a C corporation format, so you don't have to worry about those additional tax considerations.
Well, I also got to say, one thing I also love is in terms of if you're a dividend stock person, producing stocks might be a little too volatile. I would say the energy infrastructure stocks, if you want dividends, would be great. Like, look at Golar, 3.34 PE ratio, but it has a 4.7% yield plus all the growth coming on in 2014. Well capitalized, great balance sheet. That is I would say the best way to play the fracking natural gas boom, because I think the U.S. will be exporting them, and China and Japan, they'll buy that natural gas, and they'll pay
Europe.
a premium for it.
Europe, so they don't have to buy it from Russia because they're scared that Putin will jack up the price. So Europe wants a diversified supply too.
Yeah, so I would say the infrastructure, Kinder Morgan's always, that's a good go-to.
Oh, yeah. Yeah, the pipeline ones, there's different types of MLPs for our listeners out there not familiar. There's commodity-producing ones like Lynn Energy, which produce oil and natural gas, and they try to hedge their production to have more stable cash flows. And then there's pipeline ones, infrastructure ones, which are safer. They either have pipelines or they have other parts of the infrastructure business like Kinder Morgan, like Enterprise Products Partners, Energy Transfer Partners, Plains All America. Those are the largest ones.
And they're not as susceptible. So if they start increasing production, people are like, oh, they're consuming. And if if prices go high, they'll still fall. So it's a very, I would say, safer bet if you need dividends, the infrastructure.
And we consider these pick and shovel companies, and one of the great things about these companies that they get their money up front, rather than like the oil producers where their revenue is sporadic and depends on how much they produce and the oil price. With these pick and shovels, a lot of their revenue when they sign contract with the oil producers, they get the money up front, then they provide service for them.
They also lock in long-term contracts, Mo. So a guy who builds a pipeline like Kinder Morgan, who builds a new pipeline, might have already signed a 20-year contract with an oil producer or a natural gas producer or a natural gas liquids producer to move the material through the pipeline. And that a certain amount of material has to be moved through, or the pipeline company gets paid anyway. So it's basically like owning a toll road. If you own a pipeline, you own a toll road. You want as many cars going through the road as possible, right? So you just collect your quarter or your $6 or $10 toll now in New York City for a bridge. I actually heard it's higher than that for toll. So you're just collecting that each time, and then you reinvest your profits into upgrading the pipelines and stuff like that. Okay, well, let's wrap up the podcast here then with the gold and silver market. We're not going to cover the other commodities right now. We're running out of time. If our listeners have any questions about other specific commodities, send us an email at wallstreetformainstreet@gmail.com, or go to our main website and just fill out a comment section in our contacts page. We'll wrap things up, though, with gold and silver markets, guys. Things are starting to look good again. This is starting to remind me, I don't know about you guys, but this is starting to remind me of what happened after the 2008 crash, about a year and a half after that. That's preempting the big move.
Yeah, we're starting to see a lot of the gold and silver producers trim the fat, become more efficient, cut down their costs. I've seen a lot of mine put their mine into care and maintenance until the price goes up to a level where they can make money again. Because if you look at all the, we talked about this many times, if you look at all the average cash cost for the gold and silver producers, a lot of them for gold, the average is around $1,300, and for silver, the average is $23 to $25. So a lot of them right now are not making any money.
Mo, you mean all-in cost?
Yeah, all in. Yep,
okay,
all in cash cost.
Cash, but yeah.
Yeah. Like Silver Standard, their last quarterly earning, their all-in cash cost right now is at $25. I think it was $25. So right now, they're not making any money from their mines. So this is what we're seeing right now. We're seeing a lot of the CEOs and the management focus on how to cut down the production costs until the price of gold and silver goes back up.
Yeah, and I think we put in a secular bottom. I think the end of June was the final spike bottom for a number of reasons. And to add to your point, Mo, about care and maintenance, the silver sector was in a lot of trouble, all the producing miners, including First Majestic Silver. If the price went any lower below 18, when Pan American Silver, who used to be one of the lowest cost producer in the world, and is still one of the lower quartile producers, along with like Fresnillo and First Majestic Silver, of the larger guys, and Pan American Silver was debating putting more than one mine on care and maintenance. That's not. And the perverse thing about all this is that the demand for the metal is still rising. Investor demand still doing very well for silver. India, there's a big spike because of the attempted curvations by the Central Bank of India and the Indian government, who I don't know if there was pressure put on them to put these import duties on, but they're going to stop 500,000 employees in the Indian gold jewelry and gold industry from having work, could potentially be fired, and that created an enormous demand for silver. So it's just very, very weird, all the things that have happened in the gold and silver markets over the last 12 to 18 months. It's just been crazy story after crazy story. There were a ton of false breakouts. We've addressed this on a lot of podcasts. But I think, guys, this is finally the full bottom. I think we have finally put in a secular bottom. Maybe we retest that. I don't know about you, Mo. You're the technician. You're a better technical guy than me. Maybe we retest it once more, the bottom. That would be a really good buying opportunity. I would like to add to positions there. I hope to. I have some cash on the sidelines, quite a bit, in fact. But I think we are about ready now to go a lot higher.
There is a possibility that it could retest back one more time, but I don't think it's going to go below $19 to like $15 or $10 like all the other people are predicting out there, which is insane, because then a whole lot of silver and gold miners is going to go bankrupt. So, and also if you factor in that all the supplies have been offline now, and yet the demand is growing every day here in the U.S., in India, and in China, there's no way the price is going to stay this low forever or even go lower. The fundamentals are just too strong. So I believe around this range that we're seeing right now between $22 and $19 is the bottom right now, and I don't think it'll make all-time high by the end of the year, but I think silver will be around the upper 25.
So you think
25 and 30.
So you don't think we'll see a big spike then higher? You think we'll see a nice escalator climb high?
Yeah.
Okay.
That's the idea.
Yeah,
but I could be wrong.
I was gonna say this looks like the relief rally that that we've been anticipating for a while. So the only thing that has me concerned is that, like, I don't know if we're ready for the big big move yet, because last year it looked like it was about to break out, and they pulled out the stop. I don't think they'll pull that tapering, they did earlier this year. But I think they could, to delay the big move, I think they could pull someone who they could say, he might be a candidate for Federal Reserve, and he may dress up like a hawk, and then, when they have to put in the nomination, they just won't nominate that person. They'll eventually be yelling. But it was like the election where Romney said he was for hard money and he was against easing, and that cooled the precious metals in October. So they might try to pull something like that. So I don't want to make
to counter your argument, John. I don't want to speak about Federal Reserve chairmen or politicians. I want to just talk about the commitment of traders and the bank participation reports. They have not been this bullish, guys, in a long time. I believe Chris Marchese over at the Morgan Report was saying they have not been bullish since the gold and silver bull market started. They have not been this bullish since the late 90s. So we have a situation now where the people who control the price action, the commercials, JP Morgan, et cetera, the bullion banks, they have closed out their shorts, and they are tremendously net long. Now, maybe they want to add to their longs, but it seems to me that they're pretty darn happy, and they're taking, not only are they long a humongous amount of futures contracts on the COMEX, they are taking delivery of physical metal. They are taking the metal from the GLD to sell to Asia at a premium, so they're running out of metal there. The COMEX inventories are very low, and then they are lined up to take delivery of of metal from COMEX too, because they still can't meet the demand from Asia and other places for metal.
Yeah, you never know. They could manipulate it though more. They've done it before.
Oh yeah,
like,
I agree. I agree, but
it might not break out till next year. I'm just saying it might not break out these past 6 months.
I don't know if I expect a huge spike in the next 6 months, but I don't think we're gonna go any lower. We might retest
I don't
one
think
more
we'll
time.
go lower, but you never.
I think I'm in the camp with Mo that I think we're gonna see a nice escalator move high, where maybe every month or two we see like 50 cents, 75 cents, a buck added, which is fine with me.
I think that what will happen. I'm just saying they might try to pull something.
Yeah, you never know. That's a good point.
Well, I do know, guys, that these miners are still not going to invest money into deals. A lot of them are scared, so there's not going to be that much new supply brought online in the next couple of years, even 3 to 5 years from now, because they're still worried.
Yeah, the number one asset for a lot of these miners right now is the cash, and they want to have a comfortable position in their balance sheet with regard to cash, especially for times like these.
And figuring out any way they can to cut costs so their production costs go lower, too.
Yep.
Yeah. Okay, well, I think that's it for today. So, for listeners out there, go check out our Wall Street from Main Street Facebook fan page. Go check out Vitaly Katsanelson's article on the general stock market. Comment on it if you agree. If you want a free copy of our Petro Profit Report, you can email us at our main website or wallstreetformainstreet@gmail.com. And we'll also we've had people who've gotten a bunch of emails asking for ebooks for Genzo Parsons, because I mentioned it on another interview. If you email us, we'll send you ebooks for Genzo Parsons, Dying of Money, Adam Ferguson's When Money Dies, Fiat Money Inflation in France. We have a bunch of other things too. We can send you those. And if you're interested in any paid consulting work for us, where we do some research for you or teach you how to do stock screeners to find undervalued dividend stocks, or teach you how to find the best resource stocks that are going to go up potentially over 100% or more in the next 2 to 5 years, definitely reach out to us, because we want to help, and we like to teach, and we're very good at what we do.
And also, don't forget to go to our main website and check out our server contest that we have going on. We're giving out a free American Eagle silver coin once a month for people that subscribe to our website, that make comments to our YouTube channel, to our podcast, and our fan page and Twitter as well. So check that out. All right, guys. Well, thank you for your time. The next 6 months or so is going to be interesting. We'll see what happens.
Yeah, we got the debt ceiling coming up, the debt ceiling vote coming up, because I think over the last 85 days they haven't officially changed the debt ceiling number. They've been playing more fuzzy math games.
Well, they're definitely not going to paper with debt ceiling now.
Okay, well, thanks for listeners for listening. Please share, please like our video on YouTube, and feel free to comment on it if you have any interesting ideas, any guests you'd like us to interview, or any other topics you'd like us to cover, and thanks for listening.